Tom, good to see you. I'm glad you have time to talk today because I really want to discuss this recent market volatility. Concerns about a cooling US economy led to a market rout in early August and again kind of in early September as we record. And I want to talk through this recent volatility as we take a look at this chart from FinViz, which shows the S&P's 1 week performance. We still see a lot of red on the board here. What's going on, Tom?
Well, as you mentioned, we have a lot of volatility, and I think the market isn't quite sure which direction it can or wants to go in.
Mhm.
Um, we've gotten mixed results. We've had employment uh, readjustments in the last 2 months, which were downward or negative types of reports.
Right.
We have a Federal Reserve that's talking about cutting interest rates. So we have conflicting messages in the economy from different places, which I think makes the consumer or the investor uneasy. And so
Mhm.
we see a lot of that.
Mhm.
And again, as I know we're going to get into in just a moment, a lot of it is driven by just a handful of companies as well.
Right. I'm glad you brought that up because this is something that we've talked about before. It is known as concentration risk, where right now, Tom, as you're mentioning, 82% of the market's movement is due only to 10 stocks. So is that part of what was going on with this correction?
I think a part of it is. I know NVIDIA has had some downward tracking over the last few weeks.
Right.
A lot of the technology companies have had some problems recently. Uh, and I mean problems, I just mean in the trajectory of their stock, right? So we'll have to see where that goes. And if we had gone back to that first chart that you showed, you'll see that it's really, with all the other companies, it's kind of a mixed bag. It's about 50% green, 50% red. So in that sense, you take out those 10 companies, the market's kind of average. Uh,
Hmm.
you put in those 10, and like we just mentioned, that's what's driving the market both on an upward and a downward trajectory.
Hmm. So of course, the S&P tends to lead financial headlines. Maybe you think it's diversified since it's 500 stocks, but it, of course, as we just explained, is not diversified. So, Tom, though, how have well-diversified portfolios weathered this recent volatility?
Well, we'll go back to the philosophy of a well-diversified portfolio. Your plan, right, isn't necessarily to get the highest return,
Right.
but what it's supposed to do, I think, and what we try to design is to protect from that downside. The portfolio today hasn't done what the S&P 500 has done, which has done well overall for the year. But again, what you're trying to do is at some point there is going to be a downward turn. Most economists believe that, some a little, some a lot. And I think the overall idea is just, hey, if the market goes down 30%, you want to go down 10. If the
Right.
market goes up 30, maybe you go up 15. But again, most of our clients are retirees or near retirees. And so the last thing we want to have happen is they're drawing down on the retirement dollars and the market's going down 30%,
Right.
right? And
Right.
there's no chance that that portfolio will last through retirement.
Hmm. Well, and for those who did not have a plan, Tom, when all of this was breaking, I happened to go to Google and I typed in should I? And the first option on the drop down was sell my stocks now. So clearly people were feeling anxious. What should we keep in mind during these scary headlines?
Well, we have to try to take emotion out of it. That's when most people are trading. It's on their emotion. So they see the markets going down, it goes down into a trough, and they're like, "Oh my God, I can't take this anymore," and they get out. And unfortunately for them, most the greatest recovery days or periods are typically after the market has its worst days. And so
Right.
if you were emotional and you got out, you missed that recovery.
Hmm.
And that's where a plan comes into place. And that's where professional money managers come into play. They're going to help you take that emotion out of it and help you ride through both the crests of the wave and the drawbacks of the market.
So that we don't have to go to Google for financial or other life advice.
Yeah,
Tom,
and if you saw on that list, as we spoke about earlier, that last question is, should I eat rocks? So I think that
no, you should not.
right, you shouldn't, and I don't think we should be using Google to answer our questions.
Right. Boy, people are just silly, aren't they?
Yeah, well,
Tom, how can somebody get a hold of you to create that financial plan that is tailored to their risk tolerance to make sure that they are navigating this volatility well or even capitalizing on it?
they can always reach us by phone, 973-394-0623, or email tjoconnell@internationalfinancial.com. And we should be building those plans not only for risk tolerance, but for time frames, for
Right.
appropriateness, for
Right.
your legacy and what you're trying to accomplish with your dollars.
Right. Well said. Tom, thank you for your time today. I appreciate it.
Great seeing you. See you next week in National Harbor.
Can't wait. See you then.
Bye.